Bitcoin's rally just slammed into a wall. But what stopped it wasn't just traders taking profits. It was a massive liquidity structure forming underneath the market, an invisible barrier that reveals how money actually moves through the crypto system. Understanding this structure is far more important for any Bitcoin holder than predicting the next 24-hour price move. This isn't just a pause in the trend, it's a signal of a fundamental shift in the market's plumbing. What just happened tells a story about the true health of the market and what could be coming next. So today, we're going to pull back the curtain. We will ignore the noise of daily price charts and instead break down the sophisticated mechanics that just stop the market cold. We'll explore what this liquidity wall is, show you the evidence of how it formed, and explain what it means for the entire crypto ecosystem. Before we dive into Bitcoin's recent moves, we need to be crystal clear on what liquidity and a liquidity wall really mean. In simple terms, liquidity is how easily you can buy or sell an asset without drastically changing its price. Think of the market like a body of water. A highly liquid asset like Bitcoin is the ocean. You can make waves, but your individual actions have almost no effect on the overall water level. There's so much volume that even huge transactions are absorbed smoothly. On the other hand, a tiny, illiquid altcoin is like a small puddle. Even a little splash creates a massive ripple and displaces a huge portion of the water. This depth is something we can see on an order book depth chart. An order book is a live list of all the buy and sell orders for an asset on an exchange. The bids are from traders wanting to buy at various prices, and the asks are from traders willing to sell. A depth chart plots this data visually. The green side is the total value of all buy orders, and the red side is the total value of all sell orders. In a healthy market, these are relatively smooth slopes, but sometimes a massive number of orders pile up at one specific price. On the chart, this doesn't look like a slope. It looks like a sheer vertical cliff. That's a liquidity wall. A buy wall forms when tons of buy orders stack up, creating a strong floor of support. It shows immense demand at that price, making it difficult for the price to drop further. The opposite is a sell wall, a massive stack of sell orders that creates a powerful ceiling of resistance, capable of stopping a rally cold. But here's where these walls get deceptive. Sometimes, large players, or whales, place massive orders simply to manipulate the market. For instance, a whale might post a giant sell wall, not to actually sell, but to create fear. Other traders see the wall, panic, and sell their own coins for a bit less. The whale then secretly buys up these cheaper coins before canceling their sell wall entirely. However, the wall that Bitcoin just ran into was different. It wasn't a fake out from a single whale. It was a naturally forming structure built from the wreckage of an over-leveraged market. It was created by the very mechanics of modern crypto trading, specifically by something called a liquidation cascade. This wall wasn't just a signal, it was an event. The story of this liquidity wall begins with leverage. In today's crypto market, a huge amount of trading is done with perpetual futures. These contracts let traders bet on an asset's future price without actually owning it. And more importantly, they offer immense amounts of leverage. Leverage lets you control a large position with a small amount of your own capital. With 10x leverage, just $10,000 of your money can control a $100,000 position. This magnifies gains, but it also dramatically magnifies losses. When you open a leveraged trade, you put up collateral. If the market moves against you and your losses approach the value of your collateral, the exchange forcibly closes your position to protect its loan. That forced closure is a liquidation. Now, when billions of dollars of leverage are stacked in the same direction, the market stops behaving like a smooth ocean and starts behaving like a chain reaction. Picture a euphoric market where everyone thinks the price can only go up. Traders pile into leveraged long positions, using 25x, 50x, even 100x leverage. As the price climbs, they feel like geniuses. But this creates a ticking time bomb. A small dip in the price can trigger the first wave of liquidations. When those long positions are liquidated, the exchange is forced to market sell the underlying collateral. This creates more selling pressure, which pushes the price down even further, which then triggers the next tier of leveraged positions to be liquidated. This kicks off a domino effect, a rapid-fire sale of assets known as a cascading liquidation. What starts as a small dip can turn into a violent crash, as billions in positions are wiped out. This is exactly what helped form the liquidity wall. During the recent run-up, a huge cluster of short positions, traders betting the price would fall, were liquidated. As the price rose, an enormous concentration of potential short liquidations began clustering around a very specific, higher price level. This zone became a magnet. It also represented a high-volume area where a ton of trading had previously occurred. You had buyers who were now underwater and looking to sell at break-even, and you had traders who shorted and were in profit looking to cash out. The combination of these forces creates a center of gravity where the market has to burn a lot of energy to figure out who's in charge. But here is the part most traders completely miss. A key component of this wall is the potential for forced buying from liquidations. If the price were to push just above this level, it would trigger a short squeeze cascade. Shorts would be forced to buy Bitcoin back to close their losing positions, causing a rapid price spike. But this isn't real organic demand. It's a mechanical, forced buying event. Once that wave of liquidations is over, the rocket fuel is gone. For the price to keep climbing, it needs real, sustainable buying to step in. This is the wall the market slammed into. It's a price zone defined by a history of intense trading and, crucially, a boundary where the very nature of demand changes. The market stopped because it ran out of the easy fuel from liquidations and is now facing the much harder task of attracting fresh, organic capital. But here's where the story gets bigger than Bitcoin. To understand why this liquidity wall is such a big deal, we have to zoom out from the Bitcoin charts and look at the entire financial system. Bitcoin doesn't operate in a vacuum. Its price is deeply connected to global liquidity, the total amount of money sloshing around the world, which is heavily influenced by central banks like the US Federal Reserve. Think of the Fed as the master of the money spigot. When it wants to boost the economy, it cuts interest rates and expands the money supply. With more cash in the system and low returns on safe assets like bonds, investors are forced to take more risks. That capital often flows into assets like stocks and, you guessed it, Bitcoin. The connection is surprisingly direct. Historically, Bitcoin's bull markets have almost always coincided with periods of expanding global liquidity. On the flip side, when the Fed tightens policy by raising interest rates to fight inflation, it sucks liquidity out of the system. This makes borrowing more expensive and usually puts the brakes on crypto prices, as we saw during the aggressive rate hikes of 2022. So, the first layer of this hidden plumbing is macro liquidity. But global money is only one part of the equation. The other is the crypto market's own internal plumbing, starting with stablecoins. Stablecoins like USDT and USDC are the lifeblood of crypto trading. They act as a digital US dollar on the blockchain, allowing traders to move in and out of positions in minutes instead of waiting days for a bank transfer. This makes them the primary source of day-to-day liquidity on nearly every crypto exchange. The total value of all stablecoins represents dry powder sitting on the sidelines. When the stablecoin supply grows, it's a bullish sign that new money is entering the ecosystem. When it shrinks, capital may be heading for the exits. Finally, we have the problem of market fragmentation. This is where the structure of the market starts to matter. Unlike the stock market, the crypto market is a chaotic landscape of hundreds of exchanges, each with its own separate pool of liquidity. This fragmentation means liquidity is scattered. The institutional adoption of Bitcoin, especially through spot ETFs, is changing this game. As billions of dollars pour into these regulated products, they begin to act as a stabilizing force, deepening the liquidity on the exchanges they use. This ETF money is a different kind of capital, more systematic and less driven by short-term hype. In the long run, this dynamic helps improve market depth, and can reduce the severity of liquidation cascades. So, the wall Bitcoin hit isn't just a line on a chart. It's the intersection of three powerful forces: the flow of global money, the on-chain dynamics of stablecoins, and the fragmented nature of a market that is slowly being tamed by institutional capital. So, what does this all mean for the market? The most immediate takeaway is that liquidity walls often mark the transition from momentum-driven trends to periods of consolidation. The run of rapid price jumps, fueled by leverage and short squeezes, has met a significant structural barrier. Think of this liquidity wall as a major traffic jam on the highway. The market was cruising at high speed, but now it's hit a zone of massive congestion. This congestion is a price range where a ton of trading happened in the past. It represents a point of balance, or what analysts call a high-volume node. The market can't just floor it and speed through. It needs time to work through and absorb that supply. Consolidation phases are often characterized by choppy, sideways price action. The price tends to bounce between the upper and lower bounds of this liquidity zone as bulls and bears fight for control. The clear, one-way trend is replaced by a messy battle. During this time, the drivers of the market often shift. Before, momentum was key. Now, fundamentals and macro conditions become much more important. The market will be looking for a new narrative to justify breaking out of this range. All eyes turn to the Federal Reserve. A hint at future interest rate cuts would inject more liquidity into the system and could provide the fuel needed to break through the wall. Conversely, hawkish language about keeping rates high could strengthen it. The flow of money into Bitcoin ETFs is also a critical signal. Strong, steady inflows show that institutions may be using this consolidation period to accumulate, suggesting the wall is being slowly dismantled. But if those ETF flows dry up or reverse, it serves as a warning that institutional appetite could be fading, making an upside breakout more difficult to achieve. For investors, this signals a time to shift gears from trend following to structural analysis. It's a time for patience and observation of how the market behaves at key levels. If the price strongly defends the lower end of this liquidity zone, it's a sign of strength. But a failure to hold that floor could signal a deeper correction. Ultimately, this liquidity wall is a sign of a maturing market. As institutions move in, Bitcoin's behavior becomes less about retail hype and more about sophisticated, macro-aware capital. The formation of this wall is a natural part of the price discovery process. It is the market's way of testing conviction before its next major move. So, while everyone else is glued to the price chart, you now have the blueprint for the machinery underneath. But how can you track these forces yourself? Here's a practical dashboard of key indicators that will give you an edge in understanding where the market is really going. First, watch the order books and market depth on major exchanges. Are large buy walls forming below the current price, suggesting a strong floor? Or are massive sell walls appearing overhead, signaling heavy resistance? Remember, these can be manipulated, but they provide a live snapshot of supply and demand. Second, keep a close eye on the derivatives market. The key metric to watch here is the funding rate for perpetual futures. This is a fee paid between long and short traders. When the rate is extremely high and positive, it's a red flag for excessive greed and leverage, often preceding a correction. A negative funding rate signals heavy bearish sentiment and can set the stage for a short squeeze. Third, track liquidation data. Websites like CoinGlass offer live dashboards showing the volume of long and short liquidations. Watching for spikes in liquidations tells you when a cascade is in motion. This data reveals the raw, mechanical forces of forced selling or buying that are moving the market. Fourth, zoom out to the macro liquidity environment. Track the global M2 money supply and, more importantly, pay close attention to statements from the US Federal Reserve. Are they hinting at rate cuts, supportive of risk assets, or continued tightening, a headwind? This is the tide that lifts or lowers all boats. Fifth, watch the money flow inside the crypto ecosystem through stablecoin supply and ETF flows. Is the total market cap of major stablecoins rising? That means new capital is entering the market. Are the spot Bitcoin ETFs seeing consistent net inflows? That's your clearest signal of institutional demand and accumulation. By focusing on this dashboard, market depth, funding rates, liquidations, macro liquidity, and capital flows, you stop just reacting to price. You start to understand the why behind the what. You begin to see the market not as random lines on a chart, but as a complex system of financial plumbing. This liquidity wall is the perfect example. It's not just a resistance level, it's a structural feature of the market, built from leverage, reinforced by psychology, and ultimately defined by the global flow of money. While everyone else is staring at price charts asking what will happen next, you now understand the machinery underneath the market. You know the hidden forces that brought the trend to a halt, and more importantly, you know exactly what to watch to see how this battle for liquidity gets resolved. This is the kind of analysis that separates informed investors from speculators. If you want to keep cutting through the noise to get more data-backed insights into the hidden structures of the market, make sure to subscribe and hit the notification bell. Thanks for watching.